Listen, get your pen and pad out. How to legally pay less in taxes like the wealthy. And I promise you, this is something that could benefit you no matter what level that you're on. If you have an open mind and you want to keep more of your hard-earned money. At the end of the day, most people will end up paying $1 million in taxes. Well, what if I told you that you didn't have to if you had the right strategy, the right know-how, and the ability to understand what I'm about to share in this video? That being said, let's dive straight in. Number 4 and number 7 are my favorite, but it's some other ones that I learned as I was going through this, and I was like, oh, I forgot about this one. So I know that this is going to benefit someone. So get your pen, pad handy, screenshots ready. This article came from U.S. News Money, giving credit where it's due, and the title is 22 Legal Secrets to Help Reduce Your Taxes. So there are plenty of ways to lower your taxes, including credits, deductions, and advanced investment strategies. But let's dive in. So taxes are inevitable. Most people will probably rather not hand over a portion of their hard-earned money to the government, like I stated. Fortunately, there are plenty of legal ways to lower the amount you pay the taxman each year. These include credits, deductions, and advanced investment strategies. And some of these things may be things you're doing already. You just didn't know that you could make one simple switch to get the tax deduction from it. Some tax savings are available only to small business owners or the self-employed, while other options are based on your income level. So the tax code can and does change frequently, and this year is no exception. Many provisions to the Tax Cuts and Jobs Act of 2017 are set to expire at the end of 2025 if and how the law may be extended or amended remains to be seen. So in other words, it's still in the air. It could get extended or it could expire. So here's a look at how to pay taxes based on current law. Number 1, contribute to a retirement account. A lot of people miss out on this. I talked to several people that work jobs not knowing that a lot of times their contributions can be tax deductible. What do I mean? So certain retirement accounts allow you to get a tax deduction. So retirement account contributions are one of the easiest ways to save on taxes, and almost everyone can use this strategy. That's an excellent opportunity to reduce taxable income. You can deduct contributions to traditional 401ks and IRAs from your taxable income. Now, traditional IRAs, not the Roth IRA, they operate differently, from your taxable income and reduce the amount of federal tax you owe. These funds also grow tax-free until retirement. So that's a powerful strategy, a way for you to be able to fund your retirement, but also get a tax deduction that comes from it. There are also Roth IRA accounts, which are funded with after-tax dollars. While you don't get a tax deduction, money in the account grows tax-free and can be withdrawn tax-free in retirement. So you're not getting the upfront tax deduction because it's typically paid for with pre-tax dollars. However, you can withdraw tax-free years down the line when it's time for you to retire. So while contributions to workplace 401k accounts must be made by the end of the calendar year, tax-deductible contributions can be made to traditional IRAs up until filing deadline. So that's up until April 15th, which is powerful. So for the 2024-2025 tax years, IRA contributions are capped at $7,000 annually for workers younger than the age of 50 and $8,000 for those age 50 and older. And if you're wondering why it's a little bit higher for those age 50 and older, it's basically because they're trying to give them a little more of a threshold or high threshold because they're closer to retirement. That's pretty much how they're looking at it. Now, I think it should be a larger threshold than just $1,000 more, but hey, the rules are the rules. Number 2, open a health savings account. Some of you already may have this connected with your job. So that said, if you have an eligible high deductible medical plan, contributing to a health savings account is another way to lower taxable income. Contributions to these accounts offer an immediate tax deduction. They grow tax deferred and allow for tax-free withdrawals for qualified medical expenses. Any balance left at the end of the year rolls over indefinitely, similar to assets in a retirement account. So that's pretty good that it can roll over indefinitely. So that's money that never gets taxed if you spend it on medical expenses. So if that money was spent on medical expenses, then it doesn't get taxed. However, for the tax year 2024, tax deductible contributions of up to $8,300 can be made by those with an eligible family health insurance plan, or $4,150 for those with individual coverage. The limits rise to $8,550 and $4,300 respectively for the 2025 tax year. Those age 55 and older are entitled to deposit an additional $1,000 to their health, the HSA, like IRAs. Contributions can be made up until April 15th. So the tax filing deadline. Number 3, check for flexible spending accounts at work. And I told you my number 4 is one of my favorites. If you don't have a high deductible insurance plan, you can still pay for medical expenses with tax-free dollars if your employer offers flexible spending accounts. So that's FSAs, and they're funded with payroll deductions, which can be used to pay for expenses ranging from insurance copays to dental cleanings, over-the-counter medication. And many employers offer these FSAs for both health and dependent care. In both cases, there are limits to how much you can deposit, and money may be forfeited if not used by the end of the calendar year. So just understand, if you have a flexible spending account, there are certain rules and stipulations. Now, I told you number 4 was one of my favorites, and I'll tell you why. Number 4, use your side hustle to claim business deductions. In this day and age, a lot of people have side hustles. They understand the importance of making money online, making money outside of their job. I remember at one point, people were running from side hustles or scared to tap into a side hustle. But now people are starting to understand the relevance, the importance, the necessity of doing so. But this is one of my favorite because it gives you access to over 400 tax deductions just by having a side hustle, even if you have a job as well. But I want to get ahead of myself. So self-employed individuals, full-time or part-time, are eligible for scores of tax deductions. And it encourages people to start side gigs so they can take advantage of them. That means your freelance project or time spent as a rideshare driver could land you considerable tax savings. Some of the business deductions available include business-related vehicle mileage, which is one of my favorites as well, shipping, advertising, website fees, percentage of home internet charges used for business, professional publication subscription, dues, membership, travel, another one of my favorites, office supplies, and any expenses incurred to run your business. So if you think like a business individual, it's a lot of money you're already spending anyway that you're probably not writing off. I'm sure you got a phone bill, and who runs their business without a phone? In most cases, you're going to use your phone for business. That being said, it can be up to 100% tax deductible. Internet, miles on your vehicle, travel, all of these things that you are doing anyway, but you just may not be writing it off. If you pay for your own health, dental, or long-term care insurance, the premiums may also be deductible. So you can save a ton of money if you do it right. Keyword, do it right. However, IRS rules can be complex. So for advanced tax saving strategies, it's best to work with an accountant or just somebody who understands the tax code. It's different levels to it. It's tax strategists. It's those who are accountants, but it's also those who may be, enrolled agents. So it's different levels. But just the tax preparer alone typically may not understand the level to the tax deductions that can come along with a home-based business unless they themselves are also utilizing it. There's a lot of people who know about it, but if you're not using it, then you don't truly understand it. Because anybody who understands it, they make sure that they have some type of side gig, side business that they're doing, because it saves them tens of thousands of dollars per year, and sometimes even more, just by having this and doing it the right way. Number 5, claim a home office deduction. This actually ties into that other one, number 4, where it says, you can claim something if you're working or doing your business out of your home. So if you work for yourself and have a side business, don't be afraid to take the home office deduction. The only caveat is that you are supposed to use that room exclusively for business. I'm literally in my home office right now. So basically you want to use that to your advantage, because a percentage of what you're already paying for anyway can be deductible because you're using it for business. For instance, if an extra bedroom is used exclusively as a home office and it constitutes 1/5 of your apartment's living space, you can deduct 1/5 of rent and utility fees. However, if your office is in a shared space such as a kitchen, it probably doesn't qualify. So they're putting emphasis on that, but you know how to turn a certain area in your home into an office. And a lot of people are turning certain rooms into content creation stations. So that gives them a big tax deduction when they understand that it's an office, but they're also creating content in there. But you don't want to be a shared space like a bedroom and a kitchen, things of that nature. All right, let's speed it up. Number 6, rent out your home for business meeting. Thanks to the so-called Augusta rule, homeowners can rent out space in their homes for 14 days without reporting the income to the IRS. The catch is that the home cannot be the owner's primary place of business. So if it's not the person's primary place of business, then they can rent it out 14. That's almost half of the month without reporting the income to the IRS. That's powerful. So for business owners who don't have home offices, renting rooms in their houses for business meetings can be a way to reduce taxes. They can deduct the cost from their business taxes and then not have to claim the rental fees on their personal tax return. So for example, say you have a separate office somewhere else, but you want to use your home and a room in your home for 14 days out of the month. Now you're able to have a particular rate. Usually the rate has to make sense. And now the home that you was paying for anyway, you're renting it out to yourself in the form of a tax deduction. Not like you're having to pay yourself, obviously, but in the form of a tax deduction. But there are cautions against thinking you can charge your business an exuberant amount. Like I said, it has to be a reasonable amount as a way to avoid taxes. Instead, the price paid by the business needs to be in line with rental rates charged by comparable spaces in your market. Be sure to keep detailed records about when the meeting took place and its purpose. Number 7, write off business travel expenses even while on vacation. This is my other favorite one. I absolutely love this one because a lot of times you're going to travel anyway, but it's so many different ways to incorporate business, especially if you have an online business that it makes sense for you to talk about your business or share your business while you're out and about. But in this day of content creation, who's not creating content while they're out of town? And if you're not, consider it because it aids in helping you have it as a tax deduction. So combine a vacation with a business trip and you could reduce vacation costs by deducting the percentage of expenses spent for business purposes. This could include airfare, part of your hotel bill, proportionate to the time spent on business activities. But be cautious of mixing business and pleasure. Business owners who get greedy and begin writing off expenses that aren't legitimate business costs could find themselves in deep trouble with the IRS. So make sure you do so accordingly. Every time we go on a trip, it's pretty much a content creation trip, and we create so much content everywhere we go. It's like everywhere we go, we're creating content that we can use indefinitely. Like we still got videos from old trips that we use till this day, and we'll continue to use it. So the trip is continuing to be a tax deduction because it's always content that we can use over and over. We'll do like a template version of some videos and we're able to make that a tax deduction. Plus, a lot of the places that we go are places that we can offer a product or service to that particular area. So it's a win-win scenario. So people have to use common sense, long story short. Number 8, accelerate depreciation for business purchases. So when businesses buy property, such as machinery or office computers, they may be able to write off the purchase through a process called depreciation. This involves deducting a proportion of the purchase price each year, depending on the expected lifespan of the item. As a result, the annual deduction for even a large purchase can be quite small on a year-by-year basis. So you might buy some type of large electronic or whatever the case may be, and it can be depreciated over time on a year-by-year basis. So for the tax year of 2024 expenses, business owners can deduct 60% of the cost for certain business purchases. The remaining 40% can be written off as depreciation over several years. Known as a bonus depreciation, this provision is optional and available only for property with a useful lifespan of 20 years or less that has been purchased from an unrelated person. This small business tax benefit is scheduled to be phased out entirely by the end of 2026. So use it while you can if it makes sense to do so. Number 9, move some business compensation from wages to distributions. So business owners or pass-through entities such as S corporations may be able to reduce their overall taxes by moving some of their income from wages to owner distribution. So if you have an S corp, then hopefully you have an accountant or somebody who can help you better understand this, because it's all going to boil down to the way that you do it and the records that you keep around the way you do it. So owner operators should look hard at their mix of compensation, just so you can get a better understanding of it. Distributions aren't subject to payroll tax. So that makes a difference, making them preferable to drawing a salary from a business. However, the IRS requires S corps owners to pay themselves a reasonable salary, so you can't avoid all payroll taxes by only taking owner distribution. So, they hip to it, and they probably wrote this rule because somebody tried to overdo it. Doing so could result in hefty tax penalties if the government determines the distribution you took should have been paid as salary. Talk to an experienced tax professional about this before you just get to dabbling with that, because it's different rules and regs that go along with it. Number 10, deduct half of your self-employment taxes. This is one that I haven't tapped into, even though I understand how to minimize my self-employment taxes. This is a little bit different. So the government assesses a 15.3 Federal Insurance Contribution Act, FICA tax, basically, on all earnings to pay for Social Security and Medicare programs. While employers split the cost with their workers, self-employed individuals are responsible for paying the entire amount themselves. To compensate for the extra expense, the government will let you deduct 50% of the amount paid from your gross income, meaning you don't even need to itemize to claim this tax deduction. This will end up going on your Schedule C. Not itemizing it, it'll end up going on your Schedule C, which is powerful. Number 11, get a credit for higher education. Let's talk about it. So the government offers valuable tax credits to offset costs of higher education. The American Opportunity Tax Credit can be claimed for the first 4 years of college and provides a maximum of $2,500 per student. Many of you are probably tapped into this and just understand the power that can come from higher education. It's a credit, and that amount is deducted directly from your tax bill. If it exceeds the amount of taxes you owe, up to $1,000, may be refundable to you. Meanwhile, the lifetime learning credit is great for adults who want to boost their education and career training. This credit is worth up to $2,000 per year and helps pay for college educational expenses that improve job skills. Now, if you're done with school but still paying for your degree, an educational tax break is also available to you. Student loan interest is still deductible. Powerful. However, the days of higher education tax break may be numbered. They're apparently on the chopping block due to certain things that the congressional Republicans consider updates on the tax code. So that being said, we'll see how long they last. Number 12, contribute to a 529 plan. If you have children or plan to go back to school yourself, open a 529 plan for college savings. While there are no federal tax breaks for contributions, some states allow residents to deduct contributions on their state income taxes. So that's something that some people may want to benefit from, especially if you know you plan to go back to school yourself, or you know that you want your kids to go back to school. That's totally up to the parent, totally up to you. But what's more, withdrawals from the 529 plan are tax exempt, as they are used for qualified education purposes. That's the only purpose of the 529 plan, specifically for that. So if your child doesn't go to school or doesn't need all the money, it can be assigned to another beneficiary, or you can use up to $10,000 to repay student loans, so specifically for college, student loans, etc. Transferring up to $35,000 from these accounts to a retirement fund is also an option. Now that I didn't know. So being able to transfer that to a retirement fund is optional. That's powerful. So the Secure Act 2.0 made it very attractive in that you can convert some of the 529 savings to a Roth account. That must not have always been the case. So penalty-free transfers to a Roth IRA are only allowed when 529 plan has been in existence for at least 15 years and the money being transferred has been in an account for at least 5 years. Number 13. See if you qualify for earned income tax credit. This is another one of my favorites because if you lower your tax liability enough, a lot of times you can end up qualifying for earned income tax credit just based on you making under a certain threshold, depending on what your filing status is. So for single payers, it's one thing if they have no children, or married couples filing jointly who have 3 or more children, they can do $66,000 for a married couple filing jointly. Let's keep going. Number 14, itemized state sales tax. Taxpayers who itemize their deductions can include their state income tax or sales tax on their Schedule A form. The state sales tax break is a great option if you live in a state without income taxes. And if you live in a state that has no income tax. So taxpayers can easily claim their sales tax deduction using a table provided by the IRS. They should remember to add the sales tax from any major purchase like a car, boat, things of that nature. And the federal tax deduction for state and local taxes is capped at $10,000 from all sources. Number 15, let's get ready to wrap this up. because I know this can help you get in position to legally pay less in taxes like the wealthy do. See, the wealthy, they just find loopholes. And I say loopholes, but they find ways to use the tax code to their advantage. But that doesn't mean that you don't have access to those same tax code. It may be different, but you can do it on your level as well and legally pay less in taxes. Let's talk about charitable donations. Charitable contributions made with payroll deductions, checks, cash, or donations of goods are all deductible through subject lines subject to limits based on your adjusted gross income, and you'll need to itemize to claim the deduction. That's only if you itemize it. Most people don't really benefit from the charitable donations like they think. They might put it on on their tax filing, but unless you're itemizing and it supersedes the standard deduction, then you're not benefiting from it. So, that being said, it's important for you to know whether or not you truly are itemizing. Otherwise, the charitable donation won't even matter. A lot of people are taking the standard deduction because it ended up getting higher. So it just made more sense for people to take the standard deduction. Number 16, donate your required minimum distribution. So another way to support charities and lower your tax liability at the same time is to donate required minimum distribution, known as RMDs, from retirement accounts. At the age of 73, retirees must begin taking RMDs from traditional retirement accounts such as traditional 401k plans and IRAs. This money is considered income, and depending on the amount, it could significantly increase a person's overall tax bill. So RMDs require minimum distribution. You would definitely have to get with somebody who understands how this operates and does that. That being said, it's a link in the description if you need access to some tax experts, etc. Making a qualified charitable distribution is one way to bypass these taxes. Assuming you don't need money from an RMD, it can be sent directly to a qualified charity, which removes the distribution from your gross income. Strategy. Number 17, adjust your basis for capital gains tax. Investors, when calculating the cost basis after selling a financial asset, make sure to include all of the reinvested dividends. This increases the cost basis and reduces your capital gain when you sell the investment, aka you pay less in taxes on the capital gains. If you sell your house, you may also have to pay capital gains tax, particularly if property's value has risen significantly. Single taxpayers can exempt up to $250,000 of their home's appreciation from capital gains tax, while married couples get a $500,000 exemption. It's perks to being married. The IRS allows taxpayers to claim the exemption only once every 2 years. That's not bad. Once every 2 years, that's pretty significant. That is powerful. However, you can reduce how much you owe if you made home renovations or improvements. The cost of the upgrades can be used to adjust the cost basis of your property. Powerful. 18. Avoid capital gains tax by donating stock. Another way to avoid capital gains tax is to use stocks for charitable gifts. Donate an appreciated item in your portfolio. Basically, doing so allows you to skip paying capital gains tax on the appreciated value while also supporting the charity of your choice. If you want to keep a stock or a fund in your portfolio, you can simply buy more and reset the cost basis for yourself. Many people use donor advised funds to donate stocks, but you can make a gift without one. Talk to a charity of your choice to see if they accept securities. If so, they likely have a staff who can walk you through that process if that's something you want to do. Number 19, and we got 3 more and we're going to be out of here. Claim deductions for military members. So if you're military reserves like the National Guard and you travel more than 100 miles from home and need to be away overnight, you can deduct unreimbursed travel expenses such as transportation, meals, and lodging. If you're an active duty service member, you can deduct any costs associated with moving for a permanent change of station, which happens all the time. They travel and, they have to travel pretty far in order to move and relocate. Well, you can deduct any costs associated with moving for a permanent change of station. Number 20, make energy efficient updates. So the Inflation Reduction Act of 2022 extended and expanded federal tax credits for energy efficiency updates made to homes and businesses. Now through 2032, homeowners can claim up to $3,200 annually in credits for certain improvements such as installing heat pumps, energy efficient windows and doors, insulation, and similar upgrades. A separate credit is offered for the installation of solar panels, wind energy, and geothermal systems and battery storages. So if you have made any energy efficient updates, it's opportunity right there, going all the way through 2032. 2021, last but certainly not least, or next to last but certainly not least, write off your gambling losses. For those of you who are out there gambling, that's not my thing, but did you know that you can write off your gambling losses? So gamblers who win big will need to pay taxes on their winnings, but there's a way to reduce the amount owed. They forget they can write off losses. See, a lot of times you may win big, but you probably took a couple of L's on the way. You need to be able to write off those losses. Otherwise, you find yourself getting taxed very high for those big earnings. So keep records and use your losses to offset your gains at tax time. 22, don't forget state and local tax breaks. State and local taxes can add up, so don't forget to look for ways to reduce your tax burden there as well. While the 2017 federal tax reform law eliminated miscellaneous deductions, many states still allow them or may have lower threshold for claiming them. For instance, in New Jersey, taxpayers can deduct the cost of medical expenses exceeding 2% of their adjusted gross income. On federal tax form, only medical expenses of more than 7.5% of a person's AGI are deductible, and they have to be itemized. Tax savings aren't limited to income taxes either. In New York City, for example, there's a parking tax for some rented spaces, but residents can effectively waive a portion of the fee by requesting an exemption. So wherever you live, check with your local and state taxing authorities to see what deductions might be available. So this was a lot. This video was a lot longer than I anticipated it to be, but if you stuck around to the end, then this puts you in a position to know of the many tax deductions that exist that can help you keep more of your money. I light up when I hear about tax deductions because I think it makes sense for us to legally lower our tax liability. Now, I know there are talks of there being no income tax, and I'm okay with that as well. So I would like to see how that would shift things. But for the moment, since taxes exist, then it's all about figuring out how to legally pay as little as possible so you can keep more of your hard-earned money. You worked for it, you earned it, but you got to be strategic if you want to keep it. Because if you don't have a strategy to keep your money, I can guarantee somebody has a strategy to take your money. Mr. Smith, signing out. Salute.